All right, in this video, we're going to be talking about the TDI, how it works, and how we use it. So the structure of the TDI is made up of 5 lines and 3 levels. The green line is the RSI price line. The red line is the trade signal line, known as a trigger. The yellow line is the market baseline. The blue lines is your upper and lower volatility bands. The 68 level is your upper level line, is your buying exhaustion, overbought condition. Your 50 level is your mid-level line, your median point between positive and negative sentiment. 32 level is your lower line, selling exhaustion, oversold condition. How to use the TDI. TDI is best used in a 1 hour time frame, but we use it on a 4 hour and a 15-minute as well. 68 is overbought. When the market reaches 68 level, we are looking for sales. 32 is oversold. I forgot to add in over, but 32 is oversold. When the market reaches this level, we are looking to buy. We're looking for shark fin, blood in the water. When price breaks out of the bands, forming a shark fin, then coming back into the bands. We're looking for diversions. Price going down on the TDI, but at the same time, price is going up on the chart. Or price moving up on the TDI, and at the same time, price moving down on the chart. So down here is your TDI. This maroon line I put here so I can highlight your stationary 50, right? You have 50, the 50 mid level, I call stationary 50. The middle level right here. I call this your stationary 50, right? This yellow line is your market baseline. When the market baseline is above the stationary 50, we're in the uptrend, looking for buys. When the market baseline is below the stationary 50, we're in a downtrend and we're looking for sales. All right, so the market baseline, it likes to move on the uptrend. It will move from the stationary 50 to overbought to the stationary 50 to overbought before crossing back down for a downtrend. Then once they cross the stationary 50 to the seller sentiment of the market, it will oscillate between oversold to the stationary 50 back down to oversold. All right, so if you look at this screenshot, the market baseline is sitting above the stationary 50 and price is moving up. Cross is below the stationary 50, price is moving down. The cross is back above the stationary 50, price is going up. All right, next we have price. Price is the green line. So price, it likes to oscillate between oversold and just above the stationary 50 in a downtrend, and between overbought and just below the stationary 50 in the uptrend. So you got all your EMAs on top of price. We're in a downtrend. Price on the TDI is below the stationary 50. We're in a downtrend and it's dropping, catching sales. Price consolidates at the mid level at the stationary 50, breaks, stays above, then starts trending up between this overbought back down to the stationary 50, back to overbought. The trigger line is this red line, right? So your trigger line helps you get into trades and find good positions. So like I said in the previous slide, 68 is overbought. And when price gets overbought, we're looking to sell. So price is at overbought. Price crossed the trigger right here, and then it drops, sells off. Comes down. Now we're in the seller sentiment of the market and a downtrend that oscillates between oversold and just above the stationary 50. It comes just above the stationary 50, cross the trigger again, price drops. Cross the trigger again right here, price drops. We're making our way up. Price cross the stationary 50, then consolidate right at the mid-level before crossing. You get a cross of the trigger right here, price goes up. It hit the overbought level, pulls back down to the stationary 50, right below it. Cross the trigger right here, price goes up. Price sitting now overbought, cross the trigger right here, Price makes its way back down. Bounce to the stationary 50. Consolidates near the level before crossing it. Oops. Before crossing it. Now we're looking for sales. In a downtrend, it goes for oversold just above the stationary 50, triggers, drops. So next we add back the market baseline. So now we have the market baseline, which is your yellow, price, which is your green, your RSI price line, and your trigger, which is your red signal line. All right, so when the market baseline reaches overbought and oversold, we can expect a reversal as well. Right, so putting everything together, we have your market baseline sitting out overbought, and we have price sitting out overbought. So that's two confirmations that price should be getting ready to sell off. It crosses the trigger, then it sells off. All right, we have price sitting out oversold. We have the market baseline sitting out oversold. And what happens? Price pulls back and make his way up. We're in a downtrend, so where does it go? Right back towards the stationary 50 before bouncing off and heading back down. Right down here, the market baseline is back at the stationary 50. Price crossed the trigger, giving you diversions. On the TDI, price is going across. On the chart, price is going down. So the chart and the TDI is reading two different things. It's divergence. Price makes its way up. Right, you have a trigger right here. Market baseline is out overbought. It should be making its way back down in line with price being out overbought. Getting in with the trigger, making its way back down as well. Last but not least, we have the shark fins and your volatility bands. So your volatility bands are these blue bands, right? When price breaks out of the bands, it forms a shark fin. All right, so right here, price broke out of the band and entered the band. This is what we call a shark fin. This move created a shark fin. You'll catch shark fins at the low of the day, at peak formations, high of the months, high of the years, that type of thing. All right, it's a momentum push, and a momentum push usually comes as a stop hunt, as a false move to get people induced to take the position in the wrong way. So after we see a stop hunt at oversold, overbought, we can expect price to trend the opposite direction. So in this example, we get a stop hunt to the low, shark fin, price out oversold, shark fin, blood in the water. Comes, get a trigger, have our W pattern right here, trigger right here, entry right here. You'll learn more about that later. That was on your 15. This is your 1 hour. You have a shark fin down here. Price cross your trigger line. On the chart, price is going up. You have your shift candle right here. So 5 and 13 crossing. Like I said, you'll learn more about that later on in the course. This is your 4 hour. You have a shark fin, blood in the water at overbought. This is a peak formation high. Shifts confirm the 5 and the 13 cross, confirming level 1, confirming this peak formation. And you have your TDI confirmation with your 4 hour shark fin. All right. Next, you have divergence. So you have your shark fin, blood in the water. Price is moving down on the chart, and price is moving up on the TDI. Market baseline is near oversold. Up here, you have price moving up, creating higher highs on the chart. On the TDI, price is moving down. Your market baseline is out overbought. All right, so once your market baseline reaches overbought, oversold, you'll be able to spot divergence, and divergence is a good indication that the market should be making its way back down as a reversal or a strong pullback. All right, so that's our TDI. Watch this video, get familiar with how the TDI moves. Go in your chart and just go through and see how TDI moves with the chart, catching shark fins and seeing how when you see a shark fin at the oversold over broad level, how it drops off and sells off or how it rallies up. All right, so this is your TDI.